afternoon, everybody. This is your boy Marcus Norman from Gentleman Style Podcast, your host of the #1 podcast coming to you live in America. And today we have a very, very special guest of mine. I want to thank him for coming on the show today. You all are going to in for a treat. You all are going to be blessed today by this very powerful and impactful man. I have Mr. Jeremy Rowe. Mr. Jeremy started investing. This is just a little tidbit about him. This is just trimming the surface. This is the icing on the cake. But Mr. Jeremy Rowe started investing in real estate in 2002 and left the corporate role in 2007 to become a full-time passive cash flow investor. He is currently an investor in more than 60 opportunities across more than $1 billion worth of real estate and business assets. Mr. Jeremy Rowe, as a founder and president of Rowe Investment Group, Mr. Jeremy manages a group of over 1,500 investors who seek passive, managed, cash-flowing investments in real estate and businesses. Mr. Jeremy is also the co-founder of For Investors, by Investors, nonprofit organization that was launched also in 2007 with the goal of facilitating networking, learning, and real estate investors and bringing them into an environment with a strict no sales pitch environment. Is now the largest group of public real estate investors meeting in California with over 30,000 members. This man is powerful. This man is impactful, and this man is changing real estate for all of us. And today we have him on the show. Today, I want to introduce my very special guest. Please like, share, and subscribe, Mr. Jeremy Rowe, and let's give him a warm welcome. Mr. Jeremy Rowe, thank you, sir. I appreciate you. Yay!
Thanks for having me on. All I could say is that I appreciate being on here, and I just hope that our episode's helpful for your listeners.
It is. I know it is. Just in a short time, talking to you and learning from you, I've learned so much. So I know my audience is going to learn a tremendous amount. So diving right in, Mr. Jeremy, it was very brave of you to make the leap of faith into the leaving corporate world. What was going through your mind at that time, in that instance, when you finally crossed over and made that decision, sir?
Yeah, that's a great question. Man, there was a lot going on, actually. It was even harder than it sounds, because first challenge I had is that I was in the corporate world for over 10 years. I had really good jobs. Like, my last job was at Toyota headquarters. I was kind of middle-level manager, managing a number of people. I was at Disney headquarters before that, same thing. I worked at GM headquarters. I have an MBA from the Wharton School, which is a pretty good MBA program. And I was kind of on the really good corporate ladder path. And the challenge I had is that I kind of sat in those jobs for over 10 years. I always said to myself, like, I'm not maximizing my potential, but I don't know what to do. And it was really frustrating. I mean, I spent years trying to figure out, like, what do I do instead? And long story short is that I had gotten promoted and gone into a new division of Toyota, had a new manager in there, and we did not see eye to eye. He was not being supportive. He did not want to ruffle feathers because he just came in from the field to headquarters and didn't want to cause problems. I was having a whole bunch of challenges with some analysts under me. I was having to do their jobs for them because they weren't really properly qualified. In any event, long story short is that I took the leap of faith because I was a little bit fed up. And I was actually, it was a very challenging situation for someone like me who's really low risk. And it ended up being like the best thing that ever happened to me in my working world, because without that, I wouldn't have left. But what allowed me and enabled me to leave was the fact that I had the cash flow built up already. And it wasn't that I went down the path to create the cash flow to leave the corporate world. I wanted to have the paycheck and the cash flow, with the cash flow being for just more predictability for my retirement account versus just being in stocks and bonds, that were a lot less predictable, I thought. But thankfully, I had the cash flow built up to live off of. Now, in 2007, it was June, my wife was pregnant and was expecting our first child in November. She was on maternity leave, wasn't planning on going back to work with that. I never had left the corporate world, wanted to leave the corporate world. And I actually fully anticipated a recession coming up. So, like, all that is crazy timing. But I had a lot of confidence in the cash flow we had. I built up a cash flow ratio of, like, versus cost of living at the time of over 2 to 1. So we had a lot of padding in case, some stuff didn't perform during the downturn. And I tend to targeted stuff that, like, would typically do well during a downturn overall, right? So it was a really, really challenging time, and it was a major move. But because I had the comfort of the cash flow, that's really what allowed me to leave, in combination with that really challenging situation that I had in the corporate world at the time.
Wow. So that's incredible. And I think a lot of people who are interested or watching struggle with that same thing. But you mentioned two very powerful things: predictability and cash flow. Having those two and having the support of your family, you were able to make the transition. Um, and predictability in your investments, that's important to you. Why is predictability so important for your investment portfolio?
Yeah, and I want to touch upon something as well too. You mentioned, I think it's really important to support a family, because I don't really talk about that much. It doesn't come up much, when I'm on some other podcasts or in discussions. But the reality is, like, I was very lucky because I had a wife who was, with an upcoming kid, was willing to kind of make a bet on me, and believe that I was going to be able to support the family leaving the corporate world at the time that we were about to have the kid, where she was leaving her job, right? So it takes a tremendous amount of support, because if you don't have that support, I can only imagine the types of challenges that's going to happen in a marriage, or even if you're just dating somebody. So that's a really good point. And so I'm sorry, I actually lost track of your question there. What was your question again?
Predictability and family support and cash flow. No, great. I'm glad that you said that, because that's important. In order to have that leap of faith, we got to have that was at your core. So in order to keep your investments going and to have the courage, you had predictability, you had a sustainable cash flow that you were working on since 2002, and family. So that you answered it.
Yeah. Well, so what happened with me is, how I got into all this was back in 2001. The dot-com crash happened in the stock market, for anyone who's old enough to remember that. And it just killed me, because I'm a really low risk, slow and steady guy. I'm not in the market to like go up and down 30% a year. I'm just not that guy. I just wanted more predictability. And what occurred to me was that if I keep going down the stock market path, where's my retirement account going to be in 10, 20, 30 years? How many more crashes I'm going to be through? Like, where is that going to end up, right? And so the reason why I got into all this was truly just for predictability. And what that means is that when I look for something to invest in from a cash flow perspective, it's going to be pretty low on the risk spectrum, right? So I'm trading off the potential increased value or gains in exchange for more predictability. And what I like to tell people is that I truly want to go to sleep tonight, wake up tomorrow, and not much has changed, because I live off the cash flow. That's the kind of stuff I've been looking for since day one. And I continue to look for the exact same thing 19 years later. And what's also really important is that that's a really good personality fit for me, right? So it's not just about, in my opinion, it's not just about, okay, this is what's kind of working because the family needs this and all this. It's also the fact that it was a good personality fit for me. And I was looking to get away from what was not as good of a personality fit for me, which was the stock market. So that was really the catalyst. And I really can't emphasize enough the importance of that predictability even today, right? Because I'm still out of the corporate world because of predictability. If the predictability wasn't there, the lack of predictability could cause a lot of challenges for me and put me back in the corporate world. So that's what I continue to focus on, hopefully for the rest of my life, is that predictability.
Yes, sir. And that's powerful. That's powerful. How do you, when people come to you and when you mentor and you teach others, and when you connect with others, what is it that you're seeing with other real estate investors? Is it that same level of discomfort with predictability and not having that?
Well, I'll tell you, there's 1,000 ways to invest in real estate and other things, and I just am one way of doing it. So what I'm doing is the best personality fit for me. It's not necessarily the right fit for everybody. I talk to some investors who maybe will target development opportunities, which is kind of the highest risk of the spectrum, so to speak. There's probably even higher risk than that, but it's pretty high risk. And that's just the right personality fit for them. They don't need cash flow right now. They just want the highest returns possible. There's plenty of people I talk to who are just like me, who are looking for more predictability and just looking for that predictable cash flow. And there's everything in between. Some people are willing to trade off some cash flow and or predictability in exchange for higher returns, right?
Yes, sir.
So I would say that it really depends on the individual. And I'm not an investment advisor or anything like that. I'm just sharing my perspective investor. But my strong perspective is that regardless of what you're investing in or focusing on, just make sure it's the right personality fit for you, because that's going to be the most comfortable situation for you. Hopefully the best overall outcome for you, because you did what was the best personality fit for you. So I am definitely not saying predictability is the right fit for everybody, just to be clear, right? It just happens to be the best fit for me.
Yes, sir. Yes, sir. Thank you for that. Thank you for that powerful introduction. Hey, y'all, this is Mr. Jeremy Roll from CEO of Roll Investment Group. Dropping nuggets for us today, dropping gold nuggets that we can use to learn and grow. I hope you all are taking notes. I'm taking notes. And I hope this message serves. Please like, share, and subscribe to podcast. So we can reach as many people as we can, and we can help others, and we can grow together. Mr. Rose, how do you recommend? How did you get started? Let's start there. How did you get started? Did you use syndication? Did you use traditional bank mortgages? What seems to be the best hard money loans? Seems to be the best path to that passive real estate investing?
Yeah, great question. So, I think the path's going to be different for everybody. For me, I was really lucky, honestly, because I started in syndications. And the reason why I did that is because I happen to have lifelong friends in my family who'd already been syndicating for 10 to 20 years. I know them since I was literally like 4 years old. I lived right around the corner from them, basically played street hockey with their kid and all this type of thing. And it was a multi-generational family type of business. And so I was able to start with them, and for a couple of important reasons. One is because I knew I could trust them based on all that history. And two is because I knew I could learn from them, because they'd probably take more time to help me learn than the average person who syndicated who didn't know me as well, right? Probably. So I started off with them, learned a lot over a couple of years, and then started to expand out further. But by definition, I started on that syndication path because really more of luck than anything, and identifying the fact that I was able to kind of make a bet on somebody I knew well, and I was going to be able to learn a lot from them compared to the typical deal I was going to invest in. So that's how it happened for me.
So going the path of syndication allowed you to connect with someone who had already had knowledge. Is that what I'm understanding? Is that what?
Yes, but very importantly is a combination of that knowledge. And I would say, whenever I invest in something as a passive investor, I'm giving up control. And what I tell people is that, therefore, who I'm making a bet on is even more important than the property itself. Like the numbers, the property, and all the stuff that you read about on your business plan. The number one thing to me is who I'm making a bet on. The number two thing is the property. And they're a close second, like they're very close first and second. But who I'm making a bet on is definitely number one. And in that particular case, I was able to reduce the risk of who I'm making a bet on as I started, because I happened to know the people for decades, and that reduced the risk, right? I knew who I was betting on. I knew their personalities. I knew I could trust them from all these years. That was a very important point. And to be honest with you, one of the biggest lessons I've learned throughout all these years in passive investing is that I still consider who I'm making a bet on to be number one. And it actually even holds true if you're investing in startups, which I do, but very rarely, but I still do. And it is just amazing how a lot of people get caught up investing in startups where they get enamored by an idea. And this happened to me in 2000s. I made this mistake. Like you get caught up enamored in an idea or a product, and you're like, that sounds great, I got to invest in it. And then you kind of don't know the team as well, or you don't focus on that as much. Whereas if you focus on who you're making a bet on as number one, and then you kind of like the idea well enough as number two, which is a complete change in mentality, I think the probability of success is much higher. And that's proven true for me, even in my startup investing. So it holds true as well for real estate investing and any other passive investing you do where somebody else has control. So I think there's a very, very important point for people to understand.
Yes, sir. Powerful. I hope y'all, again, that you all are not going to get this anywhere else. You're getting these nuggets here from Mr. Jeremy Roll himself. So that's important, y'all. Partnering with the right people and learning about people and getting to know who because those syndications, those are relationships. It's just another form of relationship, just like marriage, just like boyfriend and girlfriend. It's a relationship. So you don't want to just go alongside someone. Thank you, Mr. Roll. That's powerful. That's really powerful. How do you analyze a deal and figure out if it's good or bad? You just mentioned that you invest on startups. You invest across the board. How do you know an investment is good or bad?
Yeah, so the startup is a little bit different than the rest of it. And startup's like 1% of what I do. Actually, to be honest with you, on startup, just to clarify, I'm not looking at startups in general. Somebody sends me a random startup, I typically won't look at it. It just once in a while, I get a startup from someone I know really well that I just have to make a bet on because they're so successful. They're a certain type of personality. And then if I like the business idea well enough to understand it well enough and say, yeah, I could see this working, but I got to make a bet on this person, that's when I go into a startup. That's like a very strict rule that I have, because when I did it the other way around, a lot of those went to zero. Some of them were okay, but most of them went to zero. Now everything's 180, where most of them are going well because of who I made a bet on, as opposed to the idea as much. So as far as trying to vet a sponsor or an operator, let's say in a real estate deal, just for example, I would say I'm trying to find someone who's conservative, like a really high level, trying to find someone who's conservative, who's looking to under promise using conservative projections, over deliver as a result of that, and is looking to build long-term relationships with investors, just to get people to invest again and again and have long-term ability to grow. What I'm trying to avoid is someone who is using aggressive assumptions, trying to make the numbers look really attractive and good, and doesn't care as much about overperforming, has a higher probability of underperforming because of all those aggressive assumptions, but doesn't really care because they're a really good marketer, or maybe they have a really big network, and therefore they could just move on to the next investor after they've got me and something doesn't perform. So by definition, I'm looking for that first bucket, trying to avoid the second bucket, and it happens to actually work out very well for me in that I tend to be very conservative, so it's a great match when I can find someone that's conservative, because we're on the same mindset and the same page. Now, keep in mind that I am looking for low risk opportunities, so it also makes sense in that context, right? For more of the predictability. It may not make perfect sense for somebody else, but overall, I think that if you take that mentality, it'll probably work most of the time, regardless of the type of thing you're investing in.
Powerful. So what fits for Mr. Jeremy Roll, y'all, doesn't fit for every investor. He wants conservative numbers, right? He's not looking for someone to promise the world and say you're going to make $1 million tomorrow. That's not what he's looking for. He's looking for conservative numbers with long-term growth and a realistic based off of projections. He wants history. He wants the data, right? And so for some of us, these fly-by-night businesses, just like Mr. Rowe mentioned, some of them can go to zero. That's it happens in investing.
Yeah, and I want to just say something really important. So for anyone out there who's looking to build wealth really quickly and is looking at a lot of like what I call get-rich-quick schemes and everything, what I've learned also over the years, and this is not like I'm sure you've heard this from other people, it's not like amazing insight, but getting rich quick just doesn't happen. It happens such a small percentage of the time. In fact, I'll even tell you, I've been in some startups. I'm in a startup right now where I think that my shares are worth almost 100 times what I invested in them. Okay, but which is crazy, right? And it's just a home run and a weird Michael Jordan situation, right? Wow. It's like a once in a lifetime thing. But you know how long I've been in that deal so far, and I still can't get my money out? It's been almost 8 years. Okay, so that's all that getting rich right off a startup, but that's still slow, right? Because I don't think they're going to IPO for another 2-3 years. It'll be 10, 11, 12 years. That's the reality, right? So you just have to be very careful, because getting rich quick is just it's not the way business works most of the time. I'm not just saying this as a conservative guy, just a realistic person. So just be very careful, because a lot of times you see get rich quick schemes. It's just not realistic more than anything. Even if you look at Facebook or even the most successful company, Uber, those are like 10, 20-year timelines to get to these many, many billion-dollar valuations typically. This doesn't happen in a year or two or three. And furthermore, even in those cases, the shareholders are often locked in from a lack of liquidity until there's an exit event, which is typically 10, 20 years down the line anyway, right? Minimum probably 5 to 7 at least. So just be very careful if you have any weird get-rich-quick schemes, because very, very small percentage of them are going to either be real and or really work out as you expect.
Yes, sir. Yes, sir. That's powerful. Ooh, I'm getting goosebumps. That's incredible. Mr. Rowe, we have a question from our audience. Is it okay if I share it?
Absolutely. Yeah, sure.
Yes, sir. So we have Miss Jacqueline Williams, and she's asking for ways to break into real estate investments without a large amount of capital or risk. Is this possible? Where would she look?
Yeah, great question. So I'm not an expert on that particular question, but here's what I will say. A lot of people who are looking to build capital early on, don't have a lot of capital to invest, will look at single family real estate investing. And there's a few reasons for that. The first is compared to, let's say, buying a big apartment building, it's obviously a lower purchase price, right? So it's more easy to attain. A lot of people who, let's say, have no capital or small amount of capital may start off first in something called wholesaling, which I've never done. But you can, you imagine you identify a property that's for sale, you put it under contract for very little money or maybe no money, and then you flip it or sell it to this contract to somebody else. So it's actually very low money or no money out of pocket for you, and you're making a spread on what you're able to buy it for versus what you can assign the contract to somebody else for a specific price they're willing to pay, and you get the difference, right? Or maybe they'll pay you $5,000 or $10,000 as a fee to have found the property at that price, as an example. So that's a very common way for people to start relatively small. The other way to do it is to really learn. A lot of people who will be in a similar position might look to maybe start flipping houses first. And what they'll do is they'll come in and they'll try and find a capital partner through networking where, you give me the capital, I'll do the work, and then maybe we'll split the profits in a certain way, right? Yes. And then you may or may not have to put any capital up, but what you do have to do is take a little time to educate yourself on how to do the flip, and get ready to do that and all that type of thing. So, and that takes time. So those are the two most common ways that I see somebody breaking into real estate with very little or no capital. But I got to be honest, I am not a good person to ask that question because I've not been through. That's more active investing, right, as opposed to passive. I've not been down that path.
Absolutely. Thank you for knocking that out of the park, sir. I think you did great, and that's a great answer, right? For most people, some places start is to build up that capital reserves. If you don't have it, start with wholesaling, right? Find the deals, work for somebody, mentorship, work for free, right? Get the knowledge. That's capital. That's knowledge capital.
Yeah. You can join a team for free, even learn. That's a great point, Marcus. And then the other thing I want to say is there's an expression I've heard from some flippers before. I love this: buy 3, get 1 free. And here's what that means. You can, if you're able to buy 3, flip them, and then take the profits from that flip. After the third one, you can often buy one yourself for buy and hold a rental. So if your goal is to build a portfolio over time and to build up your wealth with very little money to start, if you're willing to get into 3 deals, roll them over, often the fourth one you can buy with the proceeds from the first 3, and then you're starting your portfolio. So that's another thing people like to do as well.
Woo, that I told you guys, Mr. Roll here is impactful. Wisdom, knowledge, just gushing out. Oh my gosh. I have one. Who should people have on their team when investing in real estate? CPAs, tax planners. Who's your core? Who should I have at my core when I'm getting into the investing realm for the first time?
Yeah, great question. So now this is only just, I'm answering for a passive investor perspective, right? If you're an active investor, completely different situation, right? So from a passive investor perspective, the answer may surprise you because I started off talking to a bunch of attorneys trying to figure out exactly what I need to do to CPAs. Do I need to invest from an LLC? How do I need to structure this? And what I eventually came to learn is 2 very basic things. Number one, I invest directly, personally myself. I never really found, and again, I'm not an accountant or attorney, so you're going to want to talk to those. But from what I found for 19 years and talking to a lot of people, is that there isn't much benefit to, let's say, being in a company or an LLC to make your investments because you're already shielded from liability as a limited partner or a passive investor. You lose the amount of capital you invested in most cases, and you can't be sued personally. Only the general partner or the managing member can be sued, the person who's actively involved. And then from an attorney perspective, I think one of the tricky parts is learning how to read the operating agreements and the private placement memorandum, which are the 2 most common legal documents that you'll have to read before you invest. And that's something, what you could do is you can hire, if I were someone brand new, and I actually made a mistake doing this myself, I went and hired a real estate attorney to review my first few contracts, but which sounds like it would make sense, right? But what doesn't make sense about that is that real estate attorney is normally like a contract attorney who's helping to kind of close real estate deals, right? Because that's mostly what they focus on. But what they're not focused on is creating syndication documents, right? Because they're not a syndication attorney. What you're going to want is a syndication attorney who understands the ins and outs of what should and shouldn't be in an offering document. And normally those are you're the sponsor or the operator hiring those people to create the documents for you. I'd recommend an investor hire somebody 1 or 2 times to walk them through sample documents, maybe even like get a checklist from them to figure out, okay, what should I look for? What's common? What isn't common? What could be missing? And you can take sample deal and have them run them through it for you. That's who you're really going to learn properly from. Now, I didn't do that myself. What I did is eventually I did what I call opportunity exposure, which is I went and found as many opportunities as possible and compared all the legal clauses in them and try to figure out what was missing, what was not. So it's more like through experience and exposure. But if you want to fast track, I would hire a syndication attorney. Do not hire a real estate attorney, because I really didn't get very good advice from a real estate attorney. But to be honest, it wasn't really their fault because their specialty is in syndication.
Powerful. And remember, y'all, this is all depending on where where you guys stand in real estate. There are many different types of real estate investing. Mr. Rowe mentioned a few in the beginning. So if you want to go back and scroll back and review, but there are many different types. He's talking from a passive standpoint, right? Passive syndication standpoint. So keep that in mind. That's key. I don't want anyone to get that mixed up and say this is a one-shot cookie cutter type of strategy. As you grow, as you develop your real estate mindset, you'll realize what type of investor you are. Thank you, Mr. Rowe. That's great. Do you hire any virtual assistants for your business, and how do they help you push the business forward? Do you use them to find deals? Do you use them to prep your contracts? Do you use virtual assistants?
Yeah, great question. So I don't use virtual assistants probably as much as I should. I just used one for a project, and it worked out very well for like a bit of automation of my current systems. What I would say, though, is that I actually know a very active investor who just hired a virtual assistant, and I'm kind of working with them on the project to, like, his thought process is, okay, we're about to start a new cycle. Let me go out there and find some new sponsors, but how do I do that? So he basically hired a virtual assistant. He came up with the list of hundreds of sponsors that he got somewhere, and then he hired a virtual assistant to contact each of these sponsors with a list of about 5 or 10 basic questions. And what we did is we formulated a list of questions. Based on the answers, we would know, okay, is it worth for us to talk to this person, right? So meaning that, how many years of experience do they have? What is the size of their portfolio? What type of risk profile or type of asset they target? Are they cash flow focused or not, right? Just a list of 5 or 10 very basic things that I would think through in my head. And what I'd be looking for is a quick filter to begin with. And that was a very, very good use and very efficient use of a virtual assistant. Right, because you're literally, I think it was like a list of 600 sponsors.
Wow.
So I know a lot of people who leverage virtual assistants. One of the things I've been doing for a long time has been a huge help is I have a scheduling link, which I know has become very common now. Like Calendly is one very popular one. I use something called Schedule Once, where someone can just click on a link, get real-time access to your availability. I've been using that probably for 5 to 7 years before people have really heard much about it. I can't even imagine the amount of time it's saved me going back and forth scheduling meetings. I mean, it's unbelievable when you think about that. So there's a lot of automation tools out there. So I would encourage people to do a combination of virtual assistants for what they can, but also look at a lot of automation tools that people might be able to use. One more thing I just want to kind of put out there as a tip, because I do this a lot, but I think a lot of people don't do it, and I really think it makes a huge difference. This is kind of like an automation tool to an extent. So I use Outlook Desktop for my email, and I believe this is possible through Gmail and some other email platforms too. When I first meet somebody, let's say it's a sponsor, and I want to be able to get the most responsive answers for them, or the highest probability someone's going to respond to me, I say to them, what is the best way for me to reach out to you in terms of like getting you? Is it a text? Is it an email? What is it? Is it a call? And when it's an email, I'll say, okay, well, what's the best time for me to email you where they're most likely to respond? So let me give you an example. There's a sponsor I work with who said to me, I'm in the office at 5:30. If you email me between 5:30 and 7 a.m., and this is East Coast time, I'm on the West Coast, then you're going to get a response from me for within an hour because there's no one here, and that's when I'm responding to emails. But if you email me at 2 p.m., you're probably not going to get me right away, or maybe you won't get me at all. I really use a time delay function for my email. So if I'm actually sending someone an email at 5 p.m., that person, if I'm going to create an email at 4 p.m. that day, I'm going to put in a time delay till 2:30 a.m. Pacific, 5:30 a.m. Eastern. And when I do that, like literally 10 out of 10 times, I hear back from them within an hour. If I would have just sent it the day before, I might not have got a response. And so I think very carefully about when are my emails going out, what time, how am I going to increase the probability of my response time. And the reason why I'm bringing that up is because I guess it's automation when you're time delaying, you're using a your computer manage that. But then you're also reducing your own workload having to follow people if you just ask them and learn the best time to reach out to them. And I've got all different scenarios. I mean, someone this morning, 8:30, he's responding to me within 10 minutes. I actually told you today, if you email him at 7, you get a response by like 8:30. But if you email him at 2, you never hear from him. So those types of tips and tricks, in addition to virtual assistant and some automation, it can be really, really powerful.
These are nuggets, y'all. These are tips and tricks coming from the master himself. You're not going to get these anywhere else. Please like, share, and subscribe to the show. Mr. Jeremy Roll, y'all, my special guest. This is powerful. I'm excited because this is not discussed enough. And I think when people get into real estate, they don't have a mentor. The mentor is very occupied and they're busy, and rightfully so. They are busy. So this is gold, and I appreciate you. I want to say thank you live publicly for taking time out to share these nuggets, because this is gold. This is stuff I had to learn on the fly, doing my first several deals. So thank you again. Mr. Rowe, what is syndication? Because some of my listeners, they're new. Some of my audience members, they're new. So in a 30,000 level foot view, what is syndication, and why is it important to vet sponsors beforehand?
Yeah, sure. So I may be giving not the perfect definition, because I should probably Google it right now, just read it, but I won't do that. So
appreciate you.
Syndications are really the concept that somebody is purchasing a larger property and they want to pull a lot of investors together because it's a more expensive property, right? So somebody might syndicate a $10 million, $20 million, $30 million property, and by syndicating it, they're breaking into parts, meaning that instead of you having to invest $1 million to buy that $10 million property as an individual, you can maybe invest $50,000 and be amongst 50 investors in that deal. So as soon as they're opening it to many investors, they're syndicating it. And that has a whole set of rules by the SEC. You're going to have a lot of legal documents with risk disclosures and other things as a result. So there's a lot of legal documents to review when you're investing in a syndication. Typically, syndications are structured a specific way to provide investors, often with something called a preferred return and then a profit split with the operator. But high level, a syndication is when you're investing pooled with a whole bunch of other investors investing in something, and typically into an LLC. What was the second question
Vetting
again?
your sponsors. Why is it important to vet your sponsors?
Yeah, why it's so important, besides the obvious reasons of, Ponzi schemes, are you betting on a huckster, like truly, right? Is that you want to make sure that when you give control to somebody and you have such a small vote because you're one of many investors, your vote is not that meaningful. Like if you own 2% of it and you vote your 2%, it's not going to change much for you, right? So once you give someone control, they're in the driver's seat. You're just in the bus. You can't affect which way the bus is going, whether they stop at the red light or go right through it, and whether you end up in the river in the ditch, right? You just have no control over that. So once you give someone your money, your control is gone. So all the work you have to do as an investor is upfront, and it's very important that part of that process be to vet the sponsor. And you want to make sure you're not investing in someone who's fraudulent. You want to make sure you're investing with someone who's experienced, because if someone's experienced, I really hate to sound like this, but it's the truth, which is if you're investing with someone who's doing their first deal, they're learning off of your money, right? Because they can make mistakes that they're learning over time. Whereas if you invest in the 5th or 10th deal, they've already learned off other people's money, and you're benefiting from that experience and that learning, right? So it's important to understand who you're making money off from an experience perspective. And you also want to make sure that you understand their mentality. Some people are looking to be in a deal for 5 or 10 years and then have their investors exit. Some people are looking to be in a much longer term. If you're not on the same page with that person, even just from that perspective, that's important to know upfront, because once you give them your money, you sign the papers, you could be locked in for a long time, and there may be not an easy way out. Furthermore, you want to make sure that you're trying to find someone who's conservative, or at least aligning with your personality. Much better to be on the same page with somebody personality-wise than to be kind of dealing with someone who just isn't the right fit for you. And the only way you can know that is to do your due diligence. And then finally, you want to understand who you're making a bet on, because if you get to the level of understanding the personality, you'll understand how they may handle the hard times. If something happens that is unexpected, is this the right person to have made a bet on in that case or not? What type of reporting are they going to give you? Is this someone who's really detailed or not detailed? Have they been detailed in vetting the property they're buying that you're investing in? You can figure all these things out by reading between the lines as you get to know somebody. So you've got to do all this work up front, because if a deal goes really bad, usually it's the sponsor's fault. They have control. There obviously may be many factors that make it not their fault, as far as like tornado, like there's a lot of things that can happen, right? Market conditions, all stuff. But sometimes the deal goes bad because you didn't do enough due diligence, didn't realize they were the wrong person to make a bet on. They either didn't have the right amount of experience, they were just not an above board person, or they weren't the right person to handle things when things went bad. And some of that's kind of on the investor in that they could have weeded that out up front. So I'm not trying to blame investors for things going bad at all, but my point is you can reduce your risk by spending the time up front. And if you don't, you increase your risk, right? Because you haven't checked off those boxes.
Yes, sir. Yes, sir. So those are key, y'all, right? Is screening your vetting your sponsors, right? And vetting and getting to know people. This is not an overnight thing. This is not an overnight play. I've discovered and I've learned, I've met investors who get to know each other for 6 months to a year. Just getting to know each other, never investing a deal, never spending a dime, inviting him out to coffee, getting to know who you're about to invest with. And so it's not uncommon to spend that amount of time getting to know who you're dealing with and building that long-lasting partnership with for the future. We got another question. I'm gonna take one more question. Is that okay?
Oh, absolutely, yeah.
Yep. So we got a question from Ms. Shanique Henry. She is energetic. She's an investor as well. She's been in the game for several years. She asks, what is the minimum investment for a given opportunity? So I think what she means is, what's the average return that you look for when investing with someone? What kind of returns are you looking for when you know something catches your eye?
Okay. Well, I'm going to answer two questions in case she was asking, like, what's a typical minimum investment amount to go into a deal too. I'm just going to address both of those just to be sure, right? So
Perfect.
The first thing I'll say, for the actual minimum investment you have to invest in syndication, there's two different ways you can go about that. If you're going directly to the sponsor and investing directly with that sponsor, very commonly these days, the minimum investment is $50,000. Sometimes you'll find higher, sometimes you'll find lower. I would caution you if you find someone who's taking a $10,000 minimum or even a $25,000 these days, because what that tells you often is that they're not very experienced and that they're taking smaller amounts because they don't have that investor base built up yet. So now you're trading off investing less for higher risk. And I'd be very careful with that, okay? Not always the case, but very often the case. I would say the most common number you're going to see is 50,000. Now, what I will say as well is that from a return perspective, it's a very difficult time for me to answer that, because I can answer what I targeted in this last cycle, call it between 2009 and 2020, but we haven't really had the cycle reset. I don't know where numbers are going to land once this recession kind of like really plays itself out. And part of what I'm going to be targeting in the next cycle is a factor of what happens with prices, how do they change in the next couple of years? And depending on those changes, I will have different targets going forward, because I have to be realistic with what the market is offering to me, right? So I'll tell you in the last cycle that I target a minimum of 9% cash flow projected net to investors year one, and a minimum of 11% averaged annualized cash flow projected net to investors across, let's say, a 10-year average term. That doesn't include any mortgage pay down or any assumed depreciation. So if you add all the return pieces together, the typical deal I was investing in had projected returns of 15 to 18% per year annualized total. But I focus mostly on the cash flow because I live off the cash flow. That's a really important piece to me, right? That's why I started off with that. Now, those types of cash flow returns were very unrealistic in the past 4 years as the cycle was coming to an end. And so we're going to have to see what happens with asset prices once we have a reset in the cycle, and then I'll be able to determine what my new targets are going to be. I'll tell you right now, my hope is that I'll be able to target a year one cash flow of either 8 or 9%. Sorry, of either 7 or 8% first year projected net to investors, and a minimum, hopefully, of 9 or 10% average annualized cash flow projected net to investors. Again, not including the mortgage pay or any assumed depreciation, but I do think returns are going to be lower going forward because interest rates have come down over time. They're probably not going to go back up, in my opinion, for a while. And if they don't, then you're going to have to be realistic about the returns you can expect to target. But I can't give you a firm answer until the cycle resets and I'm able to see what the new pricing is.
There you go. Twofold answer. Double the trouble. Not double the trouble, but double powerful. Just double the content. So I hope that answers your questions. It answered a lot of mine, Miss Shanique. So I hope that helps. Very, very powerful. Thank you, Mr. Roll, for taking that question from our audience. This is Gentleman Style Podcast, the #1 show in America, coming to you live. Mr. Rolls, what are the different types of asset classes in real estate investing, and which is your favorite and why?
Great question. There's a lot of different things you can invest in on the real estate side. So I'm going to just quickly run through the single family stuff because I don't do quite as much of it, but I've definitely done single family flips. Hard money, which is when you're lending someone money to flip a home and you're like the mortgage, so to speak, you're the bank. You could do notes, right? So you can actually buy and sell notes, where essentially like mortgage notes that are held against properties. You can do buy and hold, right? You can buy property for cash flow long term. So that's all like the most common things. And there's other things you do too on the single family side. On the non-single family side, there's all different stuff. There is apartments, student housing apartments, RV parks, mobile home parks, self-storage, industrial, retail strip center, retail enclosed mall, office buildings, and hotels and other stuff too. I will tell you that my 4 favorite asset classes for the next 10 years, once we have a new cycle start. Now keep in mind, this works for me because I look for predictable cash flow, right? So in my opinion, these 4 asset classes are going to have the most predictable cash flow for the next 10 years based off of population trends, based off of what I see as continued demand, et cetera, low income demand, all this type of stuff. So apartments in the right location with the right operator where there's continued strong demand. I see people needing apartments for a long time, right? People are going to be living in apartments for a long time in the right location. Mobile home parks in the right locations, it's probably my favorite asset class because the turnover is very, very low. And if you have the right managers in the right locations, unfortunately, with a lot of stuff that's going to happen from the recession, people are going to demand low-income housing that's probably going to continue to be demanded. So mobile home parks can be really, really great investments, and there's some great communities for people to live in. Some of them are really, really great if they're managed well. Senior living. The population is aging. As of 2023, senior living is really expected to increase in demand based off of the aging population of the U.S. I see that being a great asset class for the next 10 years. Not so easy to manage those. You got to have the right operator, and senior living is very tricky because you can be in like a low management style, like just like an age-restricted apartment, all the way up to like, very high care, memory care, and all this. That's much harder to manage, and all these other things in between. But that I think is going to be more predictable demand for the next 10 years. And then self-storage, I think in the right locations, especially in some of the southern states where a lot of the population is migrating to right now, I think people who are moving, aging, are going to have to like downsize potentially and going to need a place to keep their stuff. So self-storage in the right locations with the right manager. Again, I see those 4 asset classes having more predictable demand. For example, retail strip centers. What's going to happen after COVID? Are people going to be buying stuff online or not? Where are they going to be buying it? What types of shops are they going to be buying from? Harder to predict. Office buildings. People are going more virtual right now, so hard to predict where the demand is going to be there in 2, 3, 4 years, let alone next year,
yes,
right?
Yes.
Hotels. I don't invest in hotels because the average daily rate literally changes every day, so that doesn't work for my predictability, right? So that's another thing I tend to stay away from. I actually never invested in a hotel ever in 19 years because of that. And so just give you some examples, but I look for predictability. So those 4 that I mentioned to me are going to have the most predictability in the next 10 years with the right location, with the right operator.
I love it. And hotels just don't go well with my anxiety. It does not fit. So I'm
hotels have had a really tough run in the last 10 years because of Airbnb. If you take a look at the numbers, they have really not increased in value much over time because Airbnb has come in and provided a lot more supply for the same type of use case, right? So someone needs a place to be overnight, and all of a sudden, all these additional rooms, these Airbnb rooms popped up, and they have not had a lot of pricing power because supply increased, and therefore also their buildings haven't had as much demand because supply has increased, and when you increase supply of anything, pricing tends to come down. So anyway.
Perfect. I think I'm gonna pinch this one last question in there from our audience. They have one more question for you. Miss Shalonda Clark, she's also a real estate investor. What are your views on condominiums as a rental property?
Great question. So I've never invested in a condo type of property, so I'm the wrong person to answer this, but I will tell you stuff I've read over time, okay, and what I've heard. Condos are interesting because they often could be less expensive to make an investment in compared to a single family home, right? So you can start off at a lower pricing point. But a couple things to note. Condos often are more volatile, meaning that people tend to run the prices up more in a good time because they're cheaper. So there's more demand, right, at the low end. But also they can come down more quickly. So they're more volatile over time. In a down cycle, they tend to decrease more than single family houses because you might have a lot more people speculating on them because they're easier to actually get a hold of because they're cheaper, right? So I'd be very careful with that. I've also heard some nightmarish scenarios about homeowners associations, challenges with those, common area problems like water leaks and mold and all the stuff that ends up being the responsibility of the actual owners of the properties as opposed to the individual owner. I think that ownership, like because you don't own something that's sitting there on your own, sometimes you need to get approval to do certain things from the HOA that can be very challenging. So there's a lot of challenges associated with condominiums that wouldn't be the same, or you wouldn't have the same challenges with single family homes. So I don't hear nearly as many people investing as condos as I do in single family homes for some of those reasons to avoid some of those risks. That being said, I'm sure there are some people who invest in condos very successfully, and they definitely are easier to get into because they're at a lower price point.
Powerful. I hope that answers your question, Shalonda. Thank you for that. That was great, Mr. Rowe. What 3 books would you recommend that every man or woman should read?
Yeah. So, all right. I have 3, I guess. The ones that come to mind immediately, the 2 that I recommend everybody read are Rich Dad, Poor Dad, followed by Cash Flow Quadrant, both written by Robert Kiyosaki. And I'd read them in that order. Okay, so Rich Dad, Poor Dad, Cash Flow Quadrant. Reading those can completely change how you view a job, cash flow, and mindset. It just really, really easy to read, not long, and very easy to understand. So I would definitely take a look at those. The last one, another one coming to mind immediately which is very basic, but it's just kind of like some very, very timeless, very basic lessons about money that can be very powerful, which is, I think, is it Rich Man of Babylon or Richest Man of Babylon? I'm confusing the title. Do you know what I'm talking about, Marcus?
Yes, sir. The Richest Man in Babylon. You had it. Yes, sir.
Thank you. Yeah. So I had my son who's just turned 13, had him read it in the past year, had him read actually all those books in the past year. Even at his age, he was able to understand all of them. Richest Man in Babylon is particularly good because the lessons are, again, they're just from like centuries ago, and they still hold true today, and they're just so powerful but easy to understand.
And they're still applicable.
I want to throw in one more bonus book, which is most people I talk to love Think and Grow Rich by Napoleon Hill. Even my son loved it. I'm one of the only people I know that didn't get that much out of it, but I will tell you, I would strongly recommend it because it's universally loved and can also really be great for mindset change and just thinking outside the box. So Think and Grow Rich by Napoleon Hill is another classic that most people swear by.
I've heard that also. I really need to get that book. You're like the 5th guest that has mentioned that book. I really need to read that book. Thank you for that. Who are your heroes, or who do you follow, and why? Yeah.
So I don't, it's funny. I don't really follow that many people. I have a ton of respect for Robert Kiyosaki and the amount of help he's given people with just those 2 books I mentioned, helping with mindset. There's an investor who is a very, very large investor, institutional investor, who has a public company, who I just admire so much because he's so good at timing the cycles, and because he just tells it like it is. Like, I have so much respect for him because it's his own company. He can get up on CNBC or whatever it is and tell it like it is. He could be on a panel and tell it like it is. And you could tell when he's sitting with other panelists that the other panelists are constrained from a political perspective. They have to kind of say the right things or they're going to get fired, right? He doesn't care about me. And he is just a master at timing and a wealth of knowledge. His name is Sam Zell, Zell. I would strongly recommend listening to him. he's just a master of timing, and I am a very big proponent of timing and cycle timing and being very cautious, and he seems to just get it right every time. So I would strongly recommend you listen to him. Another person who I think is fantastic for, I guess I would call it motivational speaking or mindset that I can kind of just listen to over and over. He's no longer alive, and you can find his videos on YouTube very easily, and so therefore it's free. But there's something about the way that he speaks. It's almost like listening to how can I put it? I don't want this to sound the wrong way because I don't know how to put it. Like if you go into a church and you listen to someone who's really good at speaking in a church and they just have you in a trance, you know what I mean? Like
Yes, sir.
You're just getting so much wealth and knowledge from them, right? And I'm not a religious person, but I'm just, because it's an obvious example to me. It just like listening to someone who's just a master of speaking in that type of area. I'm actually blanking on his name right now. So let me get back to that. He's an older gentleman who passed away. And I know I just set this up and I'm just blanking on his name. I almost feel like I should run into the room next door and ask my son, because I've given him so many videos from this person. I'm just completely blanking right now and it's killing me.
That's fine.
In any event, yeah. Hopefully it'll come back to me while we continue to talk, and I'll try and sort it out. But he's just so, I just could listen to him for hours in the background, and he just has timeless knowledge. Amazing guy.
Absolutely, that's perfect. And I hope you remember the name. If you don't, we'll connect otherwise. And I hope it comes to you.
Okay.
How do you give back to your community?
I'm picturing his face, of course, but now I'm blanking on his name. So hopefully he'll come back to me. So as far as my community, so, there's a couple things I do. I do a fundraiser every year through my investor group to try to raise money for a specific cause, and I change the cause every year. And I specifically, especially for my kids, whatever cause it is, there's always going to be something associated with work that has to be done for it, meaning that I'll do like either a walk with my kids, we'll go to like a homeless shelter, whatever it is, to try to like impart those values on them as well. But probably the biggest way that I try to give to the community is two things. One is I co-founded a nonprofit in 2007, which you mentioned in the intro, called For Investors by Investors. And we actually lose money off that every year. It actually costs me money to have that going. But the whole point was to unite investors in a forum where they knew they weren't going to have any sales pitches. And it's all about educating and networking and everything else by investors. And that is mostly chapters in Southern California. But that's one way. And but I'm happy, like, even though it costs us money, it's manageable. And the fact that it helps people is the most important thing. The other thing I do is I have calls with investors all the time. I don't charge a consulting fee. It's usually half an hour. If I can help in any way, I have those calls. And I spend a lot of time on those. So I have an average of probably a minimum of 12 calls a week, typically more. And and it's a lot of time. It's hours and hours of my time every week. But because of my knowledge, I'm able to help and give back that way. And so I'm hoping that that's helpful. And then even being on the podcast right now, really, it's just about trying to help people. I've been on over 100 podcasts, and my main goal with that is just to try to help people any way that I can. So, if this time helps one person in a very meaningful way, it's fantastic. And so that's some of the way that I try to give back.
It's powerful. Powerful. One of our audience is trying to help us. Dr. Miles Monroe. Is that?
No, it's not Miles Monroe. Okay. God damn it. It's killing me. Hopefully it'll come to me. I'm still picturing his mind. I'm almost thinking to do some Google searches, but yeah. Let me actually, while we're talking, I'm just going to, I'll pay attention, but I'm going to do a quick search while we're talking.
Absolutely, that's fine. So y'all, Mr. Jeremy Roll, y'all.
And
go ahead. Yeah. I'm sorry. Mr. Jeremy Roll.
No, go ahead. Keep talking. Keep asking questions. I'm just looking up.
No problem. Mr. Jeremy Roll, y'all. This is Gentleman Style Podcast, the #1 podcast coming to you live in America. We are interviewing Mr. Jeremy Roll, the CEO, president of Roll Investment Group, as he is helping us and serving us today and just giving back to the community. That was one of our previous questions just now. And this is a wealth of real estate knowledge. Please like, share, and subscribe to the podcast if this serves you, and I hope it does.
Marcus, I found him.
Yes.
Sorry for that. I've been blanking on this. I'm very sorry for everybody who's listening. Yes. So his name is Jim Rohn, Rohn. If you can look him up on YouTube or other places, his videos are free. He did sell some courses a while ago. I don't know if they're still even available. If you search on Jim Rohn, I found that anyone that comes up under his name or anyone that's affiliated even with YouTube that are similar type speakers, most of them weren't about the sales pitch, have just a tremendous wealth of information. I swear, if you listen to Jim Rohn for 2 or 3 hours, you'll get unbelievable lessons that would have taken decades for you to learn. That it's like everything you wish your father or grandfather, parents or whatever could have taught you. Just amazing. I can listen to him for the next decades, just over and over to get these things hammered into my head.
Wow. Powerful. So that's Robert Kiyosaki, Rich Dad, Poor Dad. Those are our major books in Cash Flow Quadrant. We have Jim Rohn as one of our greatest leaders and mentor, and someone that Mr. Jeremy Roll follows and don't want to say idolize, but he admires, respectfully admires. And so how can my audience get in touch with you, Mr. Roll? You've been powerful. You've been dynamic to the show. You've been a blessing. How can my audience get a hold of you or in the future?
Absolutely. So easiest way to reach me is email for sure. So that's jroll, JROLL. Oh, there you go. It's on the screen at rollinvestments.com. That's the easiest way to reach me.
That's the easiest way. So if anyone is looking to reach out to Mr. Roll, like you said, 12 interviews, 12 conversations a day. Best way to converse with him and schedule something, reach out to him by email. That's the best way to contact him and connect with him. That's how I reached out to him. And like I said, it was a blessing to reach out to him, and he responded when he had time. And I appreciate that, Mr. Roll. Thank you so much. All right, Mr. Roll.
No problem. Whoop. Marcus, I just want to say that is not 12 conversations a day, at least 12 a week. I could not do 12 a day, but 12 a week is what I just want to make sure that everybody knows it's not 12 a day. So,
okay.
But anyway, sorry about that.
No, you're fine. Thank you for the correction. So 12 a week. And then the rest is business, family, business, sleep, some sleep in there. Mr. Roll, thank you for coming on the show. I appreciate you. Thank you again. And I'm praying for you. I'm praying that you stay encouraged, you stay motivated, and you keep doing what you're doing, because the world needs you. The world needs what you're doing. Because that's the only way we're going to make it. That's the only way we're going to get out of this economy, is gentlemen like you pushing forward and investing and stimulating the economy, businesses like yours, stimulating the economy and moving us forward on a positive trajectory and giving back, sir. So thank you so much.
Oh, absolutely. Thanks for having me on. I just hope that this was helpful for your listeners.
It definitely was. It definitely was. I know it was impactful for me. So, ladies and gentlemen, like I always say when I end every show, this is Marcus Norman, your host of Gentleman Style Podcast, and Mr. Jeremy Roll from Roll Investment Groups. And like always, take care of your friends, take care of your families, and take care of business. This is Marcus Norman and Mr. Jeremy Roll from Roll Investment Group signing off. Thank you. Bye.